I'm going to show you how to get consistent profits with minimal risk. And the number one factor that's going to play into our success is going to be our win rate. We are going to be going for trades that give us 80+% probabilities of success. And that's before we make any adjustments or do any management. So what we're going to be doing is we're going to be writing options contracts, and that's going to allow us to control our probabilities of success. And we're going to be writing those contracts on futures, and that's going to give us very high returns on our capital, and our wins will be able to far outweigh our losers. So the first thing you want to do is open up a watch list of futures that have options available to trade on them. If your broker doesn't display this list natively, just make your own custom watch list and copy these ticker symbols. You also want to have IV rank on your watch list, and you want to order the list from high to low IV rank. And the reason why IV rank is important is because IV rank tells you where the IV of any particular underlying is with respect to itself over the past year. So you can tell, for example, ZT, which is a 2-year treasury note, it has an IV rank of 49 right now. So over the past year, the IV is currently around midway to where it's been over the past 365 days. It just lets you know where IV is relative to itself in recent times. So the reason why this is important is because volatility plays a role on option prices, and we are going to be short the option contracts, or we're going to be selling those option contracts, which means we want to sell high, buy low. And when volatility is high, option prices are high, which means we want to sell contracts when volatility is high and play the contraction of volatility. And one of the reasons why this works so well is because volatility is a mean reverting thing, and it contracts in the market about 80% of the time. So without further ado, we want to select an underlying that we can trade, and we only want to look at things to trade that have an IV rank of at least 30. Over 30 is okay, and over 50 is very good. So I like to personally be in the mid to high range, and we're just going to take a look at, say, natural gas today. Okay, it's trading at just over 4.29, and it has an IV rank of 45, which is nice and high, and an absolute IV level of 57.2%. So we should be able to get some nice premium on this trade. Premium is simply just what we're going to collect in exchange for taking the risk. That's basically how we're going to make profit, by collecting a premium. So once you've selected your underlying, you want to then pull up a list of expiration dates, option expiration dates for that particular underlying, and you want to pick an expiration date that's between 30 and 60 days out in time. So there's one here with 50 days left on it, April 25th. So we're going to open that up, and now we are presented with the options chain. We have calls on the left, puts on the right. We have this orange horizontal line that shows us where the price of natural gas is with respect to these strikes going down the middle. We have these 1 and 2 standard deviation lines, as we can see from looking at these dotted blue lines. And we also have this expected move vertical orange bar here, and if your broker doesn't display this, then it should be in the top right next to the implied volatility. The expected move will be in parentheses, so in this case right now it's plus or minus 0.67. So what we want to do is we want to sell some contracts, and I'm going to show you a strategy that I implement that works very, very well for me. So what you want to do is you want to sell one call and one put. And so when you are selling contracts, you basically want price to stay away from those contracts. When you're buying a contract, you want price to move in the direction of that contract, breach the strike of that contract, and keep going. And the more it goes, the more money you make. We're going to be selling contracts, so we're taking the opposite side of that trade, and we want price to not go near our contracts, and we want price to not breach our contracts and not keep moving past our contracts. And as long as price doesn't breach our contracts, we're going to keep all of the premium that we collect up front. So if we know what the expected move is, and we know we want price to stay away from our contracts, we simply just need to sell outside of the expected move, and that's going to give us a high probability of success. Now, the further out you go, the higher your probability of success will be. However, the less premium you will collect, so your return on capital will be lower. So it's a balance between probability of success and return on capital. I like to be around the one standard deviation level, or more specifically between 15 and 20 deltas on either side, and that usually works quite well for me. So you also want to have delta on your options chain. If it's not already natively displayed, you need to add it on. So you want to have your positive deltas on your call side, negative deltas on the put side. So we'll just start with the call side, and we're going to look for, say, we've got the 20 delta here on the call side at the 5.35 strike. We're going to sell that contract. And we have a 19 delta on the put side at the 3.75 strike here. And what you'll notice is that we are pretty much delta neutral. There's a negative 0.01 delta, net delta here between both of these positions, which is absolutely fine. That's basically delta neutral. We are in and around the one standard deviation level. We're not super close to the current at the money strikes, and we're not, way far out, 2 standard deviations plus. So we're in and around the 1 standard deviation levels. There is a bit of skew here. Obviously, as you can see, the call side is further from the put side with respect to the expected move, but that's completely fine. We're just letting the market price everything, and we're simply just going to pick our moments, i.e. in times of high implied volatility, which we've already done with an IV rank of 47, and we're just going to play the deltas, and we're just going to roll the dice. So what are our probabilities of success here? So we have a pop of 80%, and that is probability of profit. So we have an 80% chance of making money on this trade. Okay, now that's if we hold all the way till expiration, but we don't have to hold till expiration. We can get out of this position at, say, 50% of max profit. And if we were to get out 50% of max profit, we would normally be able to see this P50 number here. It's not shown for futures on tastytrade, but for equities it is. But basically your P50 is going to be about 10 to 15% higher than your pop. So we're looking at a P50 of about 90%. So I personally like to get out at 50% of max profit, sometimes even less. So if you were to do the same on this position, you'd be looking at a probability of success of around 90%. If you have got a smaller account and you really want to just bank some winners, maybe you've been unlucky in some short-term variance or something, who knows what it could be. But if let's say for example you're growing a small account, you can't really afford to take many losers, so you want a very, very high win rate. So what you could even do is take profit at, say, 25% instead of 50%, and what that's going to do is increase your win rate further. So in this instance, we have holding to expiration, we've got an 80% win rate. Getting out 50% of max profit, you're going to be around 90% win rate. Getting out 25% of max profit, you're going to be around 95 to 97%. So you're basically going to be winning almost every single time. Now, how much money can we make? So if we were to get filled at this mid price here, 0.18, we would collect a max profit, or this would be our premium that we collect up front, $1,890. So we're going to, $1,890 is going to get added to our cash balance as soon as this order gets filled automatically by our broker, and our broker is going to require 2.4k in buying power to open this position. So as you can see here, we're going to collect basically 1.9k, and we're going to be putting up 2.4k to open this position. So we are getting an almost 100% return on our capital, and this is within 50 days, not the year. And if you wanted to get out 50% of max profit, it would be 50% of this max profit number. If you want to get out 25%, it'd be 25% of this max profit number, and so on and so forth. Now you might be thinking 2.4k, maybe you have a really small account, maybe you don't want to allocate this much buying power to any one position. You can just simply, go back into your watch list and pick a different underlying to trade. Generally speaking, underlyings like currencies or things that have very low absolute IV levels, bond, soybeans, things like that, currencies, they will typically require less buying power. You could also, buy some contracts further out to cover your short contracts. I would personally try and stay away from this if possible, because it does reduce your probabilities of success. Your return on capital does significantly increase though. For example, now we would collect $350 up front, and we're only going to need $250 in buying power to open this position. But I personally like to enjoy the higher probabilities of success. So if you can, go back onto your watch list, mock up some more positions, and there are positions, there are underlyings that you can trade with the same strategy, that, $500 or less are required sometimes. So keep that in mind. Keep your position sizing in check, and basically that's the strategy. That's all you need to do. We're going to have a very high win rate. We're going to win very consistently, and every time we do win, it's not going to be pennies. We are going to be getting paid respectable chunks of money here. So you can grow an account very, very quickly doing this. And you want to have as many occurrences as you can. You want to roll the dice as many times as possible, eliminate short-term variance as best as possible. And whilst you are, learning, if you don't know how to manage positions properly, i.e., in a winning position, it's easy. You just take the position off. If price does breach one of your strikes, let's say if price tanks and it goes down to, breaches past our 3.75 put, you typically want to roll down your call side, collect more premium. You can keep going till you have basically a straddle position like this, where both your contracts are at the same strike. You can then buy the guts, sell the wings, uninvert your position, go inverted. Sorry, you can then uninvert your position later. There's so many ways that you can manage risk, manage your position, and the reason why you would do that is because the very, very few times that your position doesn't work out, you can basically turn that losing position into a scratch or even a small profit. So, it's not impossible to get a 100% or very close to 100% win rate by doing this, but you do need to know how to manage positions properly. And if you don't know how to manage positions properly, then you really need to keep your position sizing in check, your buying power requirements in check. So in order to figure out how much buying power you should be allocating to your positions, we've created a free position sizing template. The link is in the description. Just click on this button and it's going to take you over to the spreadsheet. And the way it works is very simple. You just enter in the size of your portfolio at the top. So say if you have $25,000, you enter that, and then below you enter in whatever the VIX level is. So let's just say if it is 24.1 today, and then everything's going to be calculated for you. This is going to tell you exactly how you need to structure your portfolio, how much buying power you should be allocating, or the maximum amount of buying power that you should be allocating to undefined, defined risk positions. What we went over today was an example of an undefined risk position. If you bought the longs to cover your shorts, that's an example that would be a defined risk position then. But basically this spreadsheet takes into account the size of your portfolio, and it also takes into account the volatility in the market, i.e. the VIX level. And when the VIX is higher, there's more volatility in the market. That means there's more uncertainty in the market. That means option prices are typically more overpriced, which means our edge is higher, which means we can be more aggressive. And also, the higher the VIX, the lower your chance of a black swan event occurring. So that's another reason why you can be more aggressive. So as long as you're following this guideline, outline, whatever you want to call it, you're going to be absolutely fine over the long run. And if you do want to learn in more detail, click on EDS Premium. The link for this is going to be in the description as well. This is where you can learn how to manage risk, etc. You get access to this portfolio that I showed you today. You're going to see all of the positions that we place, how we manage it, all the adjustments. Everything is going to be in real time, so you can use it to study and reverse engineer for your own positions, or you can just copy us. You can do whatever you want with that information. There's also a full course, so we will teach you everything from start to finish. No prior knowledge is required. It's a private community, so if you ever get stuck, you can simply just ask myself directly for help. I respond to every single person, every single message in the group. There's also other like-minded individuals in there, so you can collaborate together and come up with trade ideas, etc. There's a 100% money-back guarantee, so if you have been through the full course, follow some of our trades, after 6 months, if you're not profitable for whatever reason, then we will work with you for free until you are, or you can just simply request a full refund. So it's completely risk-free. It's $9.99 a month to join. The price will be increasing. Once you're in, the price is locked in for you for life, so you are rewarded for getting in early. You don't need to worry about price increases. And the aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. We want to give you the skill, and once you've learned it, no one can ever take it away from you. It's a very powerful thing to know. You can do this. You can trade in this way from anywhere in the world. It's a very relaxed way of trading. You don't need to be glued to your screen. These contracts are 30, 60 days out in time, so as long as you can log into your account once a day, once every couple of days, and just keep an eye on things, you're going to be fine. You don't need to be glued to your screen. So it is a very, very powerful thing to know. You can do this from anywhere in the world. You can do this from a payphone. You don't even need internet. You don't even need a laptop. You can literally trade by calling your broker from a payphone. That's how, flexible this whatever you want to call it, wealth generation strategy, or whatever, just running your brokerage account. It's a very simple way of doing it. And we aim to get you to a point of where you are completely self-sufficient within 6 to 12 months. So you're always welcome to stay and be a part of the community, but 6 to 12 months and you'll be good to go. So with that being said, I will see you guys on the inside.